What's going on, everybody? My name is Ryan. I'm a CPA, and man, it's been a while since I made a full-length video. Good to be back. Hope you're all doing well. We are having a pretty crazy, busy tax season. That's why, that's the reason for the absence. But today I wanted to kind of revive a series I did last year called CPA Reacts, and it's a series where I react to comments or questions either on the internet or within our firm. And just kind of, it's a good way to kind of touch on a lot of different subjects really quickly, because sometimes, it's best to go out into the people and see what they're asking and to try to educate them that way. So here we go. First question. This is from somebody from a tax preparer support group. They're asking this about their client. S Corp owner messed up payroll and paid himself much less than a reasonable salary in W-2 wages. I know he should have taken more, but now that we're about to file his return, is there any way to reclass distributions of salary so the IRS won't think he's trying to evade his taxes? I know it's too late to do a 1099 for him. Yes, so this is just, I wanted to touch on this as a reminder that, a lot of accountants and CPAs recommend business owners who are LLCs to then elect to be taxed as an S corporation. And it's not so simple. It's not just something that you just do and then you're good. There's actually a lot more complications that you have to consider, which is why at our company, we don't just blanket recommend S Corps unless it really makes sense. So one of the requirements of being an S Corp is that the owners, the active owners, have to pay themselves a W-2 salary because they are technically an employee of the corporation. And paying yourself W-2 also means there has to be a reasonable compensation. And I use that in quotes, reasonable compensation, because that differs between your region, your industry, how much profits you have in a company. So like if your company is only profiting $10,000 a year, are you expected to pay yourself a $60,000 salary to put your company at a net loss? No, I would say that's not quite reasonable. So there's a lot of factors there to consider. Now this person is asking, since this S Corp owner maybe paid himself a very minimal wage, did not meet the reasonable salary figures, should she amend W-2s? Should she file a 1099 for him? It's a good question to consider if you're like a lay person. I don't think it's a good question if you're a tax preparer, because it's something you should know. Anyways, I would say in this case, move on, look forward, have the taxpayer do it correctly moving forward. I would not worry about amending W-2s in the prior years or even in the very last year, because amending W-2s is a headache. You have to then amend the 941s, which are the payroll tax forms that go with the IRS, and then you have to do whatever you need to do with the state as well. Okay, and so that's what I would do, is just look forward, kind of ask for forgiveness, so hope the IRS doesn't get on this taxpayer for not doing it in the prior year, because the chances are they won't. I'm just saying the likelihood of the IRS auditing this for that reason is very low. So just look ahead and move forward and try to be compliant moving forward. Now, on to the second part of the question. S Corp owners usually should never take a 1099 income from their own business. They're not contractors of their company, they're employees of their company. So you cannot just instead of taking a W-2 because you're too lazy to set up wage withholding and stuff, you shouldn't just pay yourself as a contractor to make up for that, because that's not legal either. All right, the next question comes from another tax preparer support group. And this question asks, I have a client who has had to get hearing aids to help him hear, $6,400. He's self-employed and could not continue working without them. He doesn't have enough for medical expenses. Research says if an expense is necessary in order to continue a business, it can be considered a business expense. What do you think? The answer here is a no, definitely not. It's not ordinary necessary for the business. It's ordinary necessary for the person, the hearing aids I'm talking, but not for the business. The business, if it were any other business, somebody who didn't need hearing aids, they could continue on without hearing aids. Plus, usually medical expenses like this are just generally a personal expense. There's no getting around that. That's for you personally. Same with like haircuts or hair dyeing, hair coloring, tanning, manicures, pedicures. All that shit is personal expenses. That is not a business expense at all. Okay. Now, that there's nuances here, obviously. I'm just talking generally for most businesses, that's not a business expense. If you are in the business of, let's say, hair modeling, you know what I mean? Hair modeling, then I'm sure, you know, the certain hairstyles that you have to do would be a business expense, you know, for your job. But if you're working in accounting like I do, or in, I don't know, in construction or a real estate agents, common one I get, your pedicures, your tanning, your manicures, all that bullshit is not a business expense at all. That's a personal expense. And the last reaction I wanted to react to is happens to come from a client in our own firm based on their misunderstanding of how inheritance work. So I just want to go over inheritances real quick. If somebody you know dies and you inherit something from them, the act of inheriting the money or the assets or whatever, that simple act is generally not taxable. Now, I'd say generally because if, you know, the person who died had tens of millions of assets, then that might be a different story, but that's on the estate level. So let's talk about general for most people, okay? The simple act of inheriting assets is not taxable. Now, what happens after you inherit the asset may be taxable, and I'll go over some of the common different things here. So if you inherit cash, that's not a taxable event. You know, some people might think it is, but it's not. If you inherit an asset like a house or stocks, that's also not a taxable event. However, if you go and sell the house or the stock afterwards, there might be some capital gains considerations there. Okay, if you inherit a Roth IRA from somebody, that is not a taxable expense, and that's not a taxable event. And if you take distributions from the Roth later down the road, that's also not a taxable event, because generally Roth contributions are post-tax, which means they're not tax deductible. That means, you know, usually they grow tax-free, and then you can withdraw from your Roth later on tax-free with no consequences there. Now here's where the hang-up happens with one of our clients. They inherited a traditional IRA. Now again, the simple act of inheriting the IRA is not a taxable event. But if you were to then say, you know, sell off all the stocks in there and then take the money out of the IRA as a distribution, that then becomes a taxable event, and it's ordinary income. It's not even capital gains, but it's ordinary income. Okay, so why is that? Well, think about it. If you contribute to your own IRA, you know, when you're 20 or 30, the contributions you made are tax deductible, which means, you know, they reduce your tax liability, they reduce your tax income, they're tax deductible. And then like 30 years later, you retire and you pull the money out. All the money you pull out is taxable income. The reason is because your contributions are deductible. That means at some point the IRS wants to collect on its taxes, and that happens when you distribute the money to yourself out of the IRA. So the same thing happens when you inherit the IRA. The person who died made contributions to it that were tax deductible in their life, and then they died, and then you inherited the IRA, and now you want to take the money out. That becomes a taxable event no matter what. Okay, that's a taxable event. Now this person had they made a statement to us saying that if they knew the IRA was taxable, they would not have even taken the inheritance in the first place, because they didn't want to pay the taxes on it. And let me remind you that if you somebody gave you an IRA, let's say $100,000 through an inheritance, and you had to pay taxes on it, that you still have a lot of money that you didn't have before. You still net out positive, you know, even though you pay taxes on it. So I would be careful with, you know, that frame of mind, that way of thinking that just shows that you don't really fully understand how taxes work. All right, so hope this was helpful. Hope you all have a good rest of your week and weekends, and I will see you all next week. Hopefully, it's getting close to the end of the tax season, so take care. If you're new here, please consider subscribing, and if you're returning, thank you for watching. Take care.
Like that, guess I gotta hit on with the update. Okay. I been getting to it when I'm up late. Hit it when you went the front gate. They act like that, hold up. Guess I gotta hit on with the update. Really with it, I ain't got a pump fake. Killer flow and hit him with the one take. Act like that, guess I gotta hit him with the update. Okay. I been getting to it when